Good evening. Tonight we're diving into a story that's making headlines across the globe and hitting closer to home than you might think. Let's talk about the US dollar, the world's heavyweight currency, the backbone of international trade and finance, now suddenly on shaky ground. For decades, the dollar has been a symbol of American strength and stability, trusted by investors, governments, and everyday people worldwide. But now, that trust is being tested. Recently, the dollar has been falling at a pace that's raising eyebrows everywhere. And with this decline, a new term has emerged in the media and financial circles: Trumpcession, a mashup of Trump and recession. It's a catchy phrase, but behind it lies a real sense of anxiety about where the US economy is headed. The fear? That current policies, ranging from trade wars to unpredictable tweets, are steering the US economy towards serious trouble. Economists warn that these moves could trigger a recession, or, at the very least, a period of prolonged uncertainty and volatility. The dollar's decline isn't just a number on a chart. It means your money buys less abroad, making vacations and overseas purchases more expensive. At home, prices for imported goods, from electronics to groceries, start to creep up, squeezing household budgets. This isn't just a tourist problem. It hits everyone. From big multinational companies that rely on global supply chains, to small businesses and everyday shoppers trying to stretch their paychecks. When the dollar weakens, the ripple effects are felt in boardrooms and living rooms alike. The world's faith in the dollar is fading, and that has real consequences. International investors are starting to look elsewhere, and some countries are even considering alternatives to the dollar for their reserves in trade deals. The term Trumpcession points to specific policies: trade wars with China and other countries, public attacks on the central bank, and unpredictable government actions, as the root of the problem. These choices have rattled markets and made global partners nervous about relying on the US. Investors now see the US as a source of chaos, not stability. Stock markets have become more volatile, and some are pulling their money out of American assets, fearing more trouble ahead. The dollar's fall affects gas prices at the pump, the cost and availability of goods on store shelves, and even the value of your retirement savings. If the dollar keeps dropping, it could mean higher inflation and less security for your financial future. When global trust erodes, the impact is personal and far-reaching. Families worry about making ends meet, retirees watch their nest egg shrink, and businesses face tough choices about hiring and investment. Tonight, we'll break down why this is happening, what it means for you, and whether it's time to worry. We'll look at the policies behind the headlines, the real-world effects on your wallet, and what experts say could happen next. Let's dive in. The trade wars are a major culprit. Tariffs on imports, especially from China, were meant to protect American jobs, but instead created global uncertainty. Supply chains got tangled, costs rose, and companies passed those costs to consumers. Investors hate uncertainty, so they started pulling money out of the US. Trade wars slowed business, hurt American farmers and manufacturers, and made the US look risky. When you fight your biggest trading partners, you hurt your own economy. This self-inflicted damage made investors sell dollars and look elsewhere. The result? The dollar weakened. The attempt to make America great again backfired, making the economy look unstable. The trade wars cast a shadow, and under it, the dollar wilted. Investors ran for safer ground. Now let's talk about the Federal Reserve, the Fed. The Fed's independence is crucial for economic stability. But President Trump publicly attacked the Fed and its chairman, demanding lower interest rates. This undermined trust in the Fed's independence. Investors need to believe the central bank acts on data, not politics. When that trust erodes, the dollar suffers. The spectacle of a president feuding with his own central bank signaled instability. The world wondered if the Fed would cave to political pressure. This perception of chaos at the heart of the US system made the dollar look risky. Breaking the rules of global finance scares money away. The attacks on the Fed were unprecedented and damaging. The dollar's reputation took a hit. Let's talk about government debt, a topic that's often in the headlines but rarely gets the attention it truly deserves. The numbers are staggering, and the implications reach far beyond Washington, D.C. They affect every American and even ripple out to the global economy. For decades, the U.S. has been running budget deficits, spending more than it brings in. But under the Trump administration, these deficits didn't just continue, they exploded. The main culprit? Massive tax cuts that weren't matched by spending reductions. Instead of tightening the belt, the government kept spending, and the gap between income and expenses grew wider than ever. To cover these deficits, the government had to borrow more and more money, issuing a flood of treasury bonds into the market. This wasn't just a trickle. It was a deluge, with the US Treasury becoming one of the world's biggest borrowers almost overnight. When there's a surge in the supply of bonds, prices tend to fall, and yields, the interest rates paid to investors, rise. Normally, higher yields might seem attractive, but in this case, they were flashing warning signs. Investors saw higher yields as a signal that lending to the US was becoming riskier. Sure, rising yields can draw in some investors looking for better returns, but here, the story was different. The yields were rising not because of a booming economy, but because of fears that the government's finances were spiraling out of control. Investors around the world started to worry. Could the US really keep borrowing at this pace? Was there a plan to pay it all back, or was the country heading toward a fiscal cliff? The sense of unease grew as the debt kept mounting. And it wasn't just the debt. Trade wars with China, public attacks on the Federal Reserve, and political gridlock all added to the uncertainty. The US began to look less like a safe haven and more like a risky bet for global investors. The ballooning national debt raised tough questions. Would the government have to raise taxes sharply, or make deep cuts to essential programs? Or would it simply keep borrowing, pushing the problem further down the road? Some feared the US might resort to printing more money to pay its bills, a move that could unleash inflation and erode the value of the dollar. The specter of inflation loomed large, making investors even more nervous. As these fears took hold, investors began to sell off their dollars, seeking safer places for their money. The value of the US dollar started to slide, reflecting a loss of confidence in America's fiscal management. The ever-growing mountain of debt became yet another reason for investors to flee. The dollar's decline picked up speed, and the world watched as America's financial reputation took a hit. In the end, fiscal stability, a hallmark of the US for generations, suddenly seemed like a thing of the past. The deficit dilemma and bond market blues left everyone wondering, what comes next for the world's largest economy? As the dollar stumbled, other currencies rose. The euro and British pound looked more attractive by comparison. Europe and the UK weren't perfect, but they seemed more stable than the US. The euro benefited from the dollar's troubles, despite Europe's own issues. The European Central Bank wasn't under political attack, and trade wars weren't raging. Investors fleeing US uncertainty bought euros and pounds, pushing their values up. Even the pound rebounded as Brexit fears eased and US chaos grew. Money flows to where it's treated best, and lately, that wasn't the US. The rise of the euro and pound reflected America's self-inflicted wounds. The currency seesaw tipped against the dollar. Here's the paradox: despite all the headlines about America's rising debt and political gridlock, investors around the world still flock to buy US Treasury bonds, especially when a crisis hits. It might seem counterintuitive. Why would anyone want to lend money to a country that's constantly debating its own financial future? But time and again, when uncertainty strikes, the world's money rushes into America's IOUs. When global markets panic, whether it's a banking collapse, a geopolitical shock, or a sudden economic downturn, US bonds are seen as the ultimate safe haven. Investors trust that no matter what, the US government will pay them back. The US has never defaulted on its debt, and it has a unique advantage: it can print its own money. This means, in theory, it can always pay its bills, even if it has to create new dollars to do so. That's a level of security few other countries can offer. So, while long-term fears about debt and deficits can weaken the dollar, short-term panic actually strengthens it. When investors get nervous, they sell riskier assets and pile into dollars and US bonds, driving up their value. It's a strange cycle. Investors might sell dollars because they're worried about US policy or politics, but when things get scary, they buy those same dollars back to purchase US bonds. The dollar becomes both the problem and the solution. This creates a constant tug-of-war. On one side, long-term anxiety about America's finances pulls the dollar down. On the other, short-term fear yanks it back up. The result is a currency that's always in motion, never quite settling. The outcome? Volatility and confusion. Even the experts can't always agree on where the dollar will go next, and markets can swing wildly in response to the latest news or rumor. Predicting the dollar's next move is notoriously difficult. It's influenced by everything from Federal Reserve decisions to global politics, making it one of the most watched and most unpredictable assets in the world. The US is both the source of global financial instability and, paradoxically, the world's financial safe house. When trouble brews, everyone still runs to America for shelter. It's a bit like being both the arsonist and the firefighter at once, sparking the flames of uncertainty but also providing the extinguisher everyone relies on. This bizarre dynamic keeps the dollar in a state of constant flux. It's always being pushed and pulled by forces both inside and outside the US. The world can't quit the dollar even when it wants to. Alternatives exist, but none offer the same combination of safety, liquidity, and trust. That's the strange reality of global finance. America's IOUs are both a risk and a refuge, and for now the world keeps buying. The monthly US jobs report is usually a big deal. But lately, its impact has faded. Markets already expect weakness due to trade wars and policy uncertainty. Unless the report is shockingly good or bad, it doesn't change the story. The focus has shifted to bigger issues: trade wars, Fed attacks, and deficits. A single jobs report can't fix those problems. Even a decent report won't erase recession fears. The market wants real policy change, not just better data. For now, the jobs report is just background noise. The dollar's downward trend continues. What does a weaker dollar mean for you? Imported goods get more expensive: cars, electronics, wine, chocolate. Your paycheck buys less from abroad. Travel costs rise, your dollars don't go as far overseas. On the upside, US exports become cheaper for foreigners, helping some American companies. A weak dollar can boost profits for US firms earning money abroad. But overall, it signals economic weakness and uncertainty. It can hurt the stock market and erode your savings. Inflation risk rises, and your standard of living takes a hit. The world's fading confidence in the US is a warning sign. A sinking dollar is a quiet tax on everyone. It's a report card, and right now, it's not good. The US dollar, once unshakable, is now wobbly. The reasons are clear: trade wars, attacks on the Fed, and soaring debt. These policies have created a storm of uncertainty. Investors are torn, fleeing the dollar but also seeking safety in US bonds. The result is a chaotic tug-of-war. The key to the dollar's future? Policy change. Until Washington restores confidence, the pressure on the dollar will remain. The world is hedging its bets against America, and that's a sobering thought for every American wallet.